Okay, so hello everyone and welcome to the first video for 2026. Hopefully you guys are well and you obviously have enjoyed your holidays, Christmas and New Year, and hopefully you got to spend time with your family. For those of you guys who did not, that is a bit unfortunate, but again, it is a new year and it is time to actually lock in for 2026. Now, I'm a bit chilled on the recording today. There's a lot of things I want to talk about. Honestly, there's a lot of things I need to talk about. A lot of things. Now we're gonna look at the markets, but I also wanted to infuse a bit of just all of the things going on in the world. I wanted to give my personal philosophy or personal take and how you need to go about this year or how you need to approach this year in terms of what you do, the mindset you need to have for success. I made a tweet, I think it was a few weeks ago or about a month ago, and I said that I personally felt that 2026 would be a way more tougher year than 2025. And the reason why I said so is just looking at the general trajectory of where we're headed in terms of extreme manipulation in the markets and geopolitical events and economic uncertainties and inflation and high cost of living. And I personally think that all of these things would be amped up this year, right? Because if you look at the trajectory for 2025, it was not slowing down. It was actually picking up speed. It was actually increasing. The extreme manipulation with like crypto, with currencies, which I'm going to talk about. We're going to go back and take a look at currencies. Just a lot of manipulation going on. And what I realized towards the end of last year, so between the month of September to October/November, I had one of my best performance in a really long while, where I was able to, work my way up to a 400% gain. I think you could see that on my, it used to be a pin to it on my account. And then after that, the rest of the year was just a lot of losing weeks, right? Something I had not really experienced in a really long time. And I was trying to figure out what the problem was. Was it, the way I approached the markets, or was it the market itself? Like these were questions I was asking myself and trying to figure out to, kind of adapt my model to new market information. And I came to a realization that the old way of approaching the markets, the old way of trying to go into every single trading week and trying to take trades and trying to trade as much and trying to have a lot of frequency in these kind of markets where there's a lot of uncertainties, in this kind of markets where there's a lot of extreme manipulation, in this kind of markets where everyone is out to get the other person. If you are trying to trade as frequently, if you're trying to, scalp as much, and I'm specifically talking about, the currency markets and also commodity markets. A lot of people would go and trade currencies and they're, trying to scalp or day trade almost every single day, right? The one thing you need to understand is we are in a period of elevated risk, and we are also in a period of economic uncertainty. And you can see that being reflected in the markets, where we're starting to see a lot more extreme asymmetry in price action. So what does that mean? Asymmetry is when supposedly correlated assets are not correlated for a period of time. Now, typically it is meant to be short-lived. So that means that if dollar is bearish, right, we should not see USD CAD be bullish for an extended period of time. But we have a situation, especially towards the end of the year, where we would see USD CAD be bullish and Aussie also bullish, right? And cable is bearish and euro is bearish. And it's just a lot of disparity. And the reason why is because it then starts to become really confusing as to how is the market being priced and how is valuation being priced in the market when supposedly correlated assets you're no longer moving in tandem, you know, like the normal would, and we're starting to see a lot more extended periods of asymmetry in the market. Now, the one thing I've talked about with asymmetry in the market is that it is a reflection of a lack of institutional sponsorship. And that lack of institutional sponsorship is a reflection of economic uncertainty, which is what I firmly believe, especially with the government shutdowns and all of the drama with the Federal Reserve and cutting rates and the back and forth between Trump and the Fed chairman and all of that. Plus, now we have war with, not necessarily war, but of course, this is not going away anytime soon, right? The whole deal with the president of Venezuela being captured and, you know, oil and all of that. So again, that would affect oil markets. That would affect Canadian dollar. So this is gearing up to be really, really, really insane year in terms of what we're going to have to deal with, right? And I realized this the last 2 weeks of last year, and it made me come to the conclusion that everything needs to be standardized, right? Which for me is the main point of the video for today. Now, of course, I will still talk about the charts and talk about the different asset classes and price action and all of that stuff. But for me, the main topic I wanted to talk about today is the need to standardize. Now, why am I talking about the need to standardize? I personally believe that if you are not standardizing your approach to the markets, be it Bitcoin or be it equities or be it currencies or be it whatever asset class, right? We don't really care about the asset class. I personally believe that if you're not standardizing your approach in every aspect, meaning your approach in terms of your trading model and your approach in terms of also your mental model and your approach in terms of your risk model, if all of these things are not standardized and if you're leaving, saying parts of your model to guesswork, you are going to get beat by the market. Yes. And the reason why I'm saying this is because if you actually go back and do a little bit of just not necessarily back testing, but more of research as to price action on the charts the last 1-2 months going to end of the year, you would see a lot of extreme manipulation. And the one thing I did notice from my own personal trading and the results I was getting from trading, especially the last 2 months going to end of the year, was how the market was just manipulating me back and forth, right? So the price would look so bullish, right? Only for the market to flip and go bearish. Or we have situations where moves are not sustained. So a lot of extended consolidations and then stop prints on both sides, and then few periods of just one-sided price delivery, and then more extreme manipulation, which also coincides with asymmetry in the marketplace. So these are conditions that are historically really difficult to trade. I've talked about the best conditions for, to make a lot of money when it comes to trading. The best conditions obviously are market conditions in which the market is one-sided. The easiest way to make money in trading is focusing on markets that are one-sided. But now, it is easy for me to say, okay, well, just focus on markets that are one-sided and voila, you solve the problem and you're going to make a lot of money. But it is not that easy. Imagine going weeks without placing a single trade. Is that something you can do? Right? This is a question I also posed to myself towards the last few months of the year, where if I view a certain asset class, for example, if I view currencies as low probability, can I stay out for a couple of weeks, or can I stay out for maybe a month, right? Now, I'm sure you guys are probably thinking, a month? Stay out from trading for a month? That's not feasible, Gene. But this is what I'm saying, right? I'm saying this because you are going to get a lot of this kind of price action this year, this, you're going to get a lot of that, right? And for me, it is more about trying to figure out where opportunities does lie across different asset classes. The one thing I've decided to do this year is to diversify my approach and diversify my the assets I will decide to risk on. Now, let me explain why. Okay, the reason why I feel there is a need for diversification this year, especially, is because if you're putting all your eggs in one basket, currencies, for example. So for those of you guys who only trade FX, if you're putting all your eggs into FX, right? What happens when the market does something like this? What happens when you get price action like this, where it is a lot of back and forth, right? This is from the end of October to the start of January. So this is essentially over 2 months of just back and forth and no one-sided price delivery. Now, if you go back a bit, you can see we had maybe 1 or 2 weeks, actually 1 week of just one-sided price delivery, and then more of this, and then a couple of weeks of one-sided price delivery, and a couple of weeks of one-sided price delivery. If you go back a bit, you can see more of this, right? April all the way until July, right? So we're talking 1 to 3 months, over 3 months of just price just consolidated back and forth, and a few days of one-sided price delivery, few days of one-sided price delivery, more consolidation and violent retracement, and then a few days of expansion, and then more consolidation. The problem is this: if you're trading in market conditions like this, it is easy to make money. If you're trading in a market condition like this, it is easy to make money. If you're trading in a market condition like this, it is easy to blow your funded accounts. I'm using funded accounts because a lot of you guys who are probably listening to this, that's how you make your money trading or whatever. But if you're leveraged in a market like this, you're most likely losing a lot of money, especially if your risk strategy, your risk approach is not top notch, right? Then your approach will essentially cause you to blow accounts, right? In a market like this, of course, you're making a lot of money, but then you get into a condition like this where, again, it is more extended and it is just a struggle. It is so frustrating to trade a market like this, right? So now the question is, do you go in and trade in these kind of conditions, or do you avoid these kind of conditions and find opportunities in other asset classes? This is why I talked about the need to diversify. I do believe that one of the key ways that you can not only survive, but one of the key ways you can also thrive as a trader or investor this year is to start to focus on finding moments to pick your battles. And I would explain what that means. The traditional approach of going in every single trading week and trying to take as much trades and just looking at the news and all of that, that cannot be the approach right now with what is going on. And the reason why I'm saying with what is going on is that we're not in a normal environment. We're not in a normal time. We are in a period where we've seen the most economic uncertainty, one of the most, economic uncertain times with a lot. It feels like almost every single week there is huge geopolitical events going on. Either there's a problem with war in Venezuela, or there's a problem with Russia trying to do something, or there's a problem with Israel trying to do something, or there's a problem with internal conflicts with Trump and the government, right? Other parts of the government, or other parts of the government, like the Federal Reserve, for example, or the government shutdowns. There is always something going on that leads to a lot of economic uncertainty. And I personally believe that this is being reflected across asset classes, where it is every man for himself, right? It is institutions cannibalizing on other institutions, right? The market is just going sideways. If you go and take a look at dollar, for example, and if you actually look at dollar for what it is, right? If you truly, truly take a look at DXY and look at what we have on DXY. Now, of course, we had periods of one-sidedness, right? But if you actually study those periods of one-sidedness, you're going to see that it was not smooth price delivery. Now, what we're going to do here is let us actually take a look at price action between the month of June to where we are currently on DXY. So I would use a vertical line here for the month of June, and obviously we know where current price action is for January, right? And then we just go back a bit. Now, if you actually look at this price delivery in DXY or this price delivery in DXY, you can see how smooth it is, right? Smooth price delivery, right? Smooth price delivery, bit of retracement, smoother price delivery, bit of retracement, consolidation, and then we get to that higher time frame level, and we have that reversal on dollar. And once we start to break lower, you get more smooth price delivery. Bit of consolidation because price was overextended, taking out major sales of liquidity pool, then a bit of a retracement back into level of mitigation inefficiency, and then more smoother price delivery, retracement into volume balance, more smoother price delivery. So you can see how the market just delivers so cleanly into higher time frame driven liquidity. Now, here's what happened on DXY. After we ran below the slowdown here on DXY, we had one more final leg lower, and it's been a consolidation author. How do you know, Gene? But we saw the market trend, No, it has been a consolidation author because the market essentially has been trading inside a defined range, right? The defined range essentially is all of the subsequent price action post low formed at 1st of July 2025 has been inside of this range high in this range low. We have not broken above this high or below this low since the 2nd of July. So we're talking almost 6 months, or if not 6 months, of just sideways price movement. So you can see here, if you actually looked after we made the low down here, and if you actually study price action, we have a bit of a retracement, and then the market retraces back a little bit into a level of discount, volume balance, fair value gap down here, and then we have one more bit of expansion. And then after that, we have extended consolidation until FOMC release on 17th of September. That marked a quarterly low on DXY. And then we started to see the market actually rally from there, right? Now, if you actually started a rally, it was a bit more, if you go on the lower time frame, because it is easier to look at the daily time frame profile and say, okay, well, we did have a bit of a rally in DXY, which is a bit smooth. But if you actually go on the lower time frame and look at the times when those rally formed and look at how those rally formed on the lower time frame, you will see the amount of extreme manipulation. You would see the amount of off major session volatility, meaning the market just moving outside major kill zones. These are all signatures of a lower probability. A high probability market generally has most of its volatility done during the major sessions, right? The major sessions where the most volatility does occur in the market. So we're talking London session, we're talking New York session, and of course we can also include London close, right? But if you go back on dollar and you study just that rally higher on DXY, because we can compare on the lower time frames. You can see here on the Wednesday we made that FOMC low, right? FOMC set the quarterly objective on DXY, which was higher. Now I'm going to talk about what I do think about DXY, and of course Bitcoin and gold and currencies and bonds and all of that, right? But if you study the price action here, you can see here on dollar, right? We make the low, the market expands a little bit, stop trend manipulation, which is cool. We get an expansion during New York session. That is cool, right? And then going into Friday, of course, right? The market starts to rally a little bit. And then going into Monday, we get our classic valuation by speculation, where the market retraces back down to a discount, right? Inefficiency in here plus break a block in here, the market trades down there, accumulates a little bit, and then going into London session, we start to see the market rally until New York session. New York session offers no opportunities to trade, right? That's okay, right? Tuesday was a consolidation profile. If you're trading Tuesday, you're likely not making money. If you missed the chance to trade in London session, you're not making money on this day, right? So that already is 2 days off. If you wanted to continue going long in the XY, you're not making money. Obviously, we don't like to trade on Mondays because Mondays typically would, create this sort of profile of either consolidation or retracement against order flow, right? So the next week after we mark the quarterly low on the XY, you're not really getting major opportunities. If your focus is New York session or London close, like I do, you're not really getting a lot of opportunities to find clean trading market conditions. And going into Thursday, and you can see again during New York session here, the whole of London session, Asian session, London session, no volatility. New York session does offer volatility. So if you're trading on this day, aligning yourself with order flow, then of course you're making a lot of money. All right. And then after all of that expansion into higher time frame target objective, we get a bit of a seeking of fair valuation, right? Because now the market is a bit overextended. So we have a bit of a mean reversion to fair value where the market returns back down to a discount. But now watch this. Of course, on Fridays, we don't like to trade on Fridays, except it is a TGIF opportunity, right? So Fridays would be one of those days where you're most likely not trading. So now yet you had one clean opportunity. If you focused trading a London session, then you had just one clean opportunity to capitalize on the longs. Now, the next week, on Monday, seeking a short profile. So if you're trading on this day, you're losing money. Tuesday, seeking a short profile. If you're trading on this day, you're losing money. Wednesday, seeking a short profile. If you're trading this day, you're losing money. Thursday was also a bit similar, but even if you wanted to, because most people are not buying down here, which is the one thing a lot of people don't realize when they look at price action in hindsight. A lot of people like to focus on the good parts because the bad parts of price action, it is painful to acknowledge. But realistically, you're not catching the bottom down here. You're probably looking to buy after you have the break, or you're probably looking to buy a lower time frame retracement or whatnot. So if you are aligned bullish on DXY, you're more than likely buying somewhere around here. So that means even if you positioned yourself to get a really good move on the XY, it was not sustained. You can see the moment the market runs above short-term buys liquidity up into inefficiency, the market returns back down to a discount. So any positions in here is most likely stop to break even if you did move your stops to break even. Now, of course, if you kept your stops open, more than likely you would have realized a profit, right? So again, if you look at this week of trading, Monday, Tuesday, Wednesday, the other factor that you're not considering is the mental capital of trading in these really frustrated market conditions, which is something a lot of people don't factor into when they are taking a look at price action in hindsight. Because the reason why your back testing almost always produces a better result than your live trading or your forward testing is because you're missing a crucial component to success in trading, which is the mental aspect. The more times you trade in shitty market conditions, the more you expose yourself to shitty price action, the more it eats at your confidence, which then causes you to mismanage trades or chicken out of good trades. All of these things does compound to really poor trading performance, which is something a lot of people don't factor in when they're looking at price action in hindsight. So after we made that low post FOMC, The weeks after that week where we made that low, we've only had one good trading day here if we're focused on New York session, right? So far. And maybe potentially this. But more than likely, to be honest, you're most likely getting stopped out because you're more than likely day trading or short term trading, and you were more than likely moving your stops to break even because there was a bit of a significant price delivery in DXY. Now, of course, on Friday, if you went in and traded on Friday, you are absolutely cooked again. Monday opens, and what happens? The market gaps up. If you went in on Monday and you wanted to align yourself long, looking for the clean eyes up here, nope. The market does not offer that. Monday was a signature short profile. And then Tuesday, right? Look at Tuesday's price action. We have a bit of an upside during London session. Not significant, just a little bit. If you trade a New York session, you're losing money again. So far, we've only had maybe 1 and 2. Realistically 1, but let's just say 2 good days to leverage in on dollar. But let's move on. So far, and this is the third week after we marked that quarterly low, right? So moving on, right? On Tuesday, you're not making money, right? And the reason why you're not making money on Tuesday more than likely is because again, I am assuming that you're day trading and you're not swing trading, right? The only logical way that you would be able to capitalize in a market like this is if you have positioned yourself to look for swing trades, right? So that way, all of the back and forth is not really doing anything to your position or portfolio, right? But if you're day trading, if you're short-term trading, you're more than likely losing money. And if you're day trading, you're losing a lot of money. And if you're scalping in this kind of market conditions, you're very much likely blowing accounts because scalping requires you to expose yourself a lot more to these kind of price actions. And this is the one thing I was trying to advocate against, especially towards the end of last year, which is that in market conditions like this, you want to trade as less as you can get away with. Because in a market condition like this, the risk profile is so high because you're not getting clean one-sided price deliveries. The major sessions where you do expect the volatility, you're not getting that volatility. It's a lot of back and forth, And this is what I was talking about with the market moving at weird times. Because again, if you remember, if I went back to the daily time frame on DXY, it looks as if the rally we're currently monitoring or studying on DXY, it looks as if it was very clean, but it actually was not clean. You can see all of the back and forth. You can see the market gaps up, Sunday open. You're most likely not in this move. You're most likely not in this move. Be realistic. If you try to buy continuation mode, you're most likely not in this move, right? Obviously, we don't trade on Mondays. So even if we ignore Mondays, if you went in and traded on Tuesday, you're most likely not making a lot of money. If you went in and traded on Wednesday, you're most likely getting cut up. Can you see the expansion? The expansion comes during Asian session on Wednesday, and then for the rest of the day, the market just remains in a consolidation. So this is the third week after we make that quarterly shift, and this is the second time. You can see New York session we had a bit of a one-sided price delivery. This is the second time, 3 weeks in, where you do get a clean opportunity to align yourself with bullishness in DXY. And then if you move past that, we have a bit of a retracement on Friday, which again, that can be expected because typically Thursdays to Fridays, we look for reversal trades against institutional order flow. So let's say you traded this, right? You traded a reversal trade. So we have 1, 2, and 3 good trading days in a span of 15 trading days, right? Remember, a week contains 5 trading days. 3 weeks equals 15 trading days. So you're only getting 3 opportunities to capitalize in a span of 3 weeks. So if you're trading on every other day outside these 3 trading days, especially if you're trading New York session or London close, you're more than likely losing money. Now, if you're scalping, you're more than likely blowing accounts. Can you see what I'm talking about with this kind of market conditions? Because it is easy to go back in price action, look at price on a daily time frame profile, and say to yourself, okay, well, but Gene, you said the market's consolidating, but that's not true, Gene. No, 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 no. This is why I wanted to go on the lower time frame to explain what I'm talking about with the kind of delivery. If you compare this rally here on the XY, okay, we can actually go a bit more, right? Here you can see the market does start to retrace a little on the XY, but you can see all the back and forth, Actually, let's just zoom in a little bit, right? So on Friday, we get a bit of a TGI profile. If you trade on Monday, right, during New York session, you're not making any money. There was almost no movement on the XY during New York session. What you get on Tuesday, you get a whipsaw on Tuesday. Let's assume, which very likely you would not have capitalized on, but let's assume you cut the shorts on Tuesday. That's so cool. Now you have 4 trading days and you are 17 days in post quarterly low forming, right? So on Tuesday, we're assuming here you captured the shorts. Now, continuing going into Wednesday, right? What are you looking for on Wednesday? You're looking for shorts on a Wednesday, right? Go into New York session. This is the start of New York session. In here, we get a bit of a small displacement lower, which is okay. Not a lot of price displacement. Small displacement lower, but now watch this. If you're most likely trading in on this and you're short some trading, you're most likely having to hold your trade overnight, right? If you traded somewhere inside of this on the lower time frame, this retracement maybe would have stopped you at a break even if you were day trading, maybe not if you kept your stops open. So let's assume we have 1 day of clean shorts, 2 days of clean shorts. Now look at what I'm talking about with DXY. During Asian session, that's when you get the most one-sided displacement on dollar, right? You have nothing during London session. Same thing on Thursday. Asian session, clean one-sided displacement. From there, a lot of consolidation all through, and then during London close, you have a bit of an expansion lower during London close. So if you are trying to navigate price action in here, you most likely get it cut up. And then on Friday, the market, of course, opens, gaps lower, and then reverses from here on Friday. So again, realistically, you're getting this was actually a good week if you were bearish in the XY and not bullish in the XY, right? Again, I'm trying to give the best scenario in terms of this, right? So what you're seeing here, and of course post Friday, Monday consolidation profile, you're losing money. Tuesday consolidation profile, you're losing money. Wednesday consolidation profile, you're losing money. Thursday consolidation profile, you're losing money. Friday consolidation profile, you're losing money. Next week Monday, this is a whole week of no real one-sided price leveraging. Okay, so cool. Next week Monday, what'd you get? Consolidation profile, you're losing money. Tuesday, what'd you get? Consolidation profile, you're losing money. You're when I say losing money, I mean the probabilities of you making money versus losing money means it is more tilted towards losing money because you're not getting really one-sided price delivery, right? Now, going into Wednesday, you do have a bit of a one-sided price delivery, but remember, this is FOMC. We do not trade FOMC. So you've missed Wednesday. The trading on Wednesday. Now for Thursday, you did get a bit of a one-sided price delivery, but look at when this comes on Thursday. This is what I'm talking about. Now, if you were positioned down here, the low forms during Asian session. This is Asian session down here, all right? London session starts here. That's the start of London session. That is the start of New York session. If you're trading New York session, you're not making money again. The only time really that you see the most volatility or displacement on dollar is during London launch. Not London session, not New York session on this day, post FOMC, not London close, London launch. We don't trade London launch. One of the signatures of a low probability market, right, is the fact that the volatility occurs outside your major closes, like I said before, number one, you have a lot of back and forth, a lot of no one real one-sided price delivery. And when you get one-sided price delivery, you're most likely not able to capitalize on that because maybe you have FOMC, for example, where you don't want to trade. And literally 1 week back before or prior to the FOMC release, it was just a lot of back and forth. Now, post FOMC release, again, you're not really getting opportunities because the real move comes during London launch. Now, if we move past that, again, Friday, we don't like to trade Friday, or if we're going to trade Friday, we potentially are looking for a TGI profile. So if you look for a TGI profile on Friday, you've lost money. If you try to continue to trade in alignment with the trend, you're not making as much money because you can watch this, right? London, Asian to London session, consolidation. New York session, you're getting 2 one-sided candles, and that's about it. Obviously, you would not want to hold your trade going into the new trading week if you're short-term trading or day trading, right? It's so risky, right? So you're more than likely closing your position around break-even or just for a few pips in profit. Monday, again, taking the short profile, right? Tuesday, we had the low form during London session, so the only way you're making money on Tuesday is if you traded during London session. Again, this is me ignoring all the times the previous weeks before where London session was a dud. Again, I am trying my best to be lenient and say, okay, let's only focus on all the clean one-sided price delivery and how we would have capitalized on that clean, on those clean one-sided price delivery. And if I continue to do this on and on and on, you would see the same theme, right? So you can see when we are in situations of economic uncertainty, especially with last year where we had the government shutdowns and all of the back and forth between Trump and the Federal Reserve, and now we start 2026 and we're off to our first start with bombings in a different country, and the U.S. wanted to go into Venezuela and increase oil production, and the effects that would have on dollar and the effects that would have on assets and all. It's a lot of uncertainty, right? What I'm saying is this: if you put all your eggs in one basket, like you did last year, like you've been doing years before, you have to understand that the times are changing. If you're not changing your approach, if you're not changing your strategy, if you're not trying to essentially adapt to market information, to the reality of what is going on, not only are you going to get left behind, also you will struggle, you will fail, you will get so frustrated, which is why there is a need for diversification this year. And not only is there just a need to diversify, you have to standardize models for each asset classes. Meaning you have to have a model if you want to approach investing in gold. How do you approach trading gold? Do you approach trading gold from the perspective of day trades or scalps or short-term trades or swing trades? What is the better approach to trading gold? Now, for currencies where they have a lot of experience with currencies, right? It just means our approach has to adapt or adjust with currencies, right? So again, you can see if you compare the recent market condition, like I talked about, to early on during the year, last year, right? Where we have those periods of one-sidedness in price, one-sidedness in DXY. So we can just go back a bit and just look at price action prior to all of that forming on DXY, right? I actually want to go back and look at when we had all of those clean trending market conditions. Okay, so we can watch this here. You can see this. This is Monday, right? Again, this is why I talk about not holding trades over the weekend, right? Because you can get situations where the market gaps like this, and that can blow your account. If you're trading a funded account, even if you're in profit, this kind of move can blow accounts, right? So it is very risky holding trades over the weekend, especially when the market's close to your entry level, or when you've not really locked in profits or protected your trade or your positions. Anyways, so you can see on Monday the market does revert from here, sells off. Obviously, we don't like to trade on Monday, but look at Tuesday, right? London session makes a high, clean price displacement. New York session continues that. Clean price delivery. Wednesday, same thing. London session, clean one side of price delivery until we fill in the gap and then the market starts to retrace the seek fair value. So of course we're not looking to trade continuation trades. Now we can look for potential TGIs on Thursday, Friday. Friday does offer a bit of TGI profile, but we're not really concerned with this. Right, so you can see Monday to Wednesday we had clean delivery. And the main thing I want you to focus on is the sessions in which that volatility comes in. It comes in during London session, New York session, which is what we like to see, right? Now, going to the next week, right? Monday, we don't like to trade Mondays because we can get either consolidation profiles or extreme retracements like that. Tuesday, what you get? Oh, clean one to the price delivery the whole day, right? Wednesday, what you get? A stop run, and then what? Clean price delivery. Again, my point is to focus on the sessions in which the volatility occurs. In higher probability market conditions where there's institutional sponsorship, the sponsorship in terms of the displacement, they will come at key economic releases and key major sessions, which you can see here. Right, so if we just move forward, you can see here again. So I am U to C+1, meaning for me, London session starts 7 a.m., right? New York session starts 13 o'clock, right? So whenever you see my mouse show between 7 to 11 a.m., that is New York session, and 13 to 1500 is, of course, 12 to 1500, of course, is New York session, right? So what you can see here, I just made an error there. Let me just correct that real quick. So London session here, because there is a daylight savings. So London session on this chart is 6 a.m. to 10 a.m. and New York session is 12 a.m. to 12 p.m. right to 1500, and 1500 to 1700, of course, is London close, right? So you can see again the moves occur during that time. Here we have London session, jitter swing, and then expansion. All right, cool. Here again, we did have a bit of a displacement during Asian session, but now watch this. We actually also get the more volatility during New York and London close, right, or towards London close, right? So again, the one side of price delivery. Friday, same profile. Of course, on Fridays, we don't like to trade consolidation trades generally, so we're most likely not trading this on a Friday. After this extended price delivery that takes out a major pool of liquidity, of course, we expect a bit of a retracement in price action. So Monday starts with the consolidation, which we generally do not like to trade. Tuesday, you have a bit of a consolidation again. So if you're trading on this day, you're more than likely losing money. And then on Wednesday, the market makes the high of the week, right? And this comes around London close, right? London close, which is 1500 to 1700. So that's where we make the high of the week, and then the market starts to run over. Now watch this. London session, we have downside. New York session, we have downside. So all of the volatility comes on Thursday after we make that high of the week on Wednesday. But realistically, we're not looking for shorts on Tuesday. And the reason why essentially is just because relative to our daily range, high and low, we were still at a discount, right? You can see the market returns to a level of fair value at premium in here. Fair value gap, bearish order block, and that's where we start to see the sells in DXY, right? But the one thing I want you to focus on is how clean the delivery does occur. When I say how clean delivery does occur, this is the philosophy I want to explain, right? The best opportunities in terms of trades in an ideal market that has a target driven liquidity on the higher time frame profile, the best opportunities comes when there's a clear low resistance liquidity run objective. When we have a clear low resistance liquidity run objective, and we're starting to see the market run for that low resistance liquidity and target objective, you get the easiest trades. Once the market achieves that run on liquidity, the probabilities becomes lower, because now the question is, do we continue and seek more external sell side liquidity lower, right? Down here, or do we consolidate for an extended period of time? Do we consolidate, or do we retrace into a premium and sell off, or do we just trend like this, or do we reverse altogether, right? The easiest trade is in between runs on liquidity. When we achieve a pull of liquidity, the probability becomes significantly lower, and we don't want to expose ourselves to risk in those kind of market conditions. So going back and taking a look at DXY, right? As per previous examples, you can see typically when we meet a short-term target objective or near-term target objective. So the way I define short-term target objective, whenever I talk about a short-term target objective, I simply mean a liquidity target within on the daily time frame, a closer liquidity target objective. Now, the way I define a closer liquidity target objective is a liquidity pull within the last 20 days of price action, right? So if you do your look back, if you conduct your look back, the liquidity pull within the last 20 days of price action always is your short-term target objective, right? The liquidity pull between the last 40 to 60-day look back becomes your near-term target objective. Now, when the market meets short-term target objective, like in this example here on DXY, where we trade down into a bullish order block. Again, remember, a bullish order block is a form of a discount in price action. We typically expect the market to either consolidate or expand towards near-term target objective down here, and also here. Right? Why would this be near-term target objective? Well, relative to when we achieve this down to liquidity, if you take a look back like this, you can see all of the reference points comes outside our 60-day range. So because it comes outside our 60-day range, any target objective down here becomes near-term. Now, for longer-term target objectives, I like to use weekly to monthly levels, right? Now, when we talk about long-term target objectives, we're dealing with a macro target objectives, right? But when we trade, because we don't have the same amount of capital as institutional investors, so we're forced to have to either day trade or short-term trade or scalp, because we can make a lot of money for position trading, right? When we look at targets like this, the best trades are in between runs to short-term target objectives and near-term target objectives. When we get to short-term target objectives, we do not do anything until we either invert, until we either invert a discount array. Inversion means this bullish order block price needs to trade through. If it's a fair value gap, price needs to trade through. It makes it an inversion block here or an inversion gap here. That is the only time we trade continuations. But when the market meets short-term target objectives like this, we wait for retracement back into daily time frame, fair value. Essentially, we're waiting for retracement back into premium if we're bearish, right? When the market returns back into premium, we go back into looking for short-term opportunities to align ourselves with the trend. When we get to near-term target objectives like this, this is where we start to consider the possibility of either reversal, okay, or continuation. Now, this is where you go a bit outside and do your analysis on areas like interest rate disparity or commitment of traders report or open interest, right? This is where you zoom out and you start to look at the bigger picture. How does that tie in with bonds and all of that question? But when we get to short-term target objectives like this, we're not really looking for a reversal, right? When we see moves like this, we don't think moves like that is a reversal because we still have that near-term target objective. The market moves in quarterly targets. The market ever rarely is one-sided for just extended periods of time. Now, maybe on assets like USD JPY, and USD JPY is a special case, which, I'll do a video on USD JPY as to why we get long-term trends in USD JPY. But for other asset classes, you're not really getting long-term trends, right? You're getting periods of sustained price delivery, and then the market returns back to a mean reversion. So a mean reversion essentially is when the market becomes either overbought or oversold, and I'm not talking about RSI, right? I'm talking about overbought or oversold from an institutional perspective. The market would seek to return back to a level of equilibrium. This is the nature of price action, right? And the reason why is because currencies are not necessarily assets that can just keep going up infinitely, like the equities market or like gold or like Bitcoin. Okay, the currency market is a way to gauge economic policies. So which is why a lot of times the currency market is the mean reversion market. A mean reversion market essentially is a market, and a market that is not really an asset. It cannot go up infinitely. It cannot go down infinitely. So all this expecting sustained trends on currency assets, that's not a good approach. Now, of course, you cannot use the same approach on assets like the equities market. I saw a lot of people trying to call a crash in equities. And if you remember, throughout the whole of last year, I maintained equities can go up infinitely longer than you can keep trying to short them. And I personally do believe that this year we will get a continued sustained run higher on equities, right? So I've included equities as assets that I'm starting to monitor, and I've been working on my own model, personal model on equities as I foray into these markets full time this year. So this year we're going to have equities market included along with currency markets, and we're also going to have Bitcoin. I'm also going to have gold. So there, of course, will be a model for trading currencies, and then there will be a model for trading assets like Bitcoin and gold, and then there will be a model for trading other assets like equities, right? And the reason why, again, it's just all about diversifying your portfolio. Essentially, what that means is I am only looking to capitalize on high probability market conditions. No more trying to go in every single trading week and trying to hunt for opportunities that are non-existent, because what you're essentially doing is every time you expose yourself to risk in these low probability markets with DXY and what we're seeing in currencies, you erode your mental capital. You also erode your equity. That's why a lot of people struggled last year, because this is not I'm gonna be honest, this was a really tough market, or a really, really, really tough market with all of the. Remember when I did the analysis post FOMC and all of this run higher, we only had maybe four, or not four, we only had about 5 or 6 opportunities to capitalize on the one side of price delivery. Because you can look at this on the daily time frame and say, okay, but Gene, the market still went up. It was still bullish. But just like you've seen, the bullishness either came overnight, during Asian session when you're asleep, outside your kill zones, and if you were focusing on the kill zones where you expect the most volatility, you're definitely blowing accounts or losing a lot of money. So the only way you could have navigated this kind of market condition and not lose money but actually make money is if you only traded about 5 times. 5 times within the span of 50 days, right? Within the span of 50 days, you're getting 5 or 6 opportunities to leverage in on the longs. And this is ignoring the TGI profiles. and just ignoring all the times where TGI food is not offered on a Friday. So you can see how wild that is. And this is not even me working in this kind of long extended range in DXY, all of that. So again, I do believe that the markets are highly, highly manipulated right now. Everyone is trying to increase your wealth. Everyone is trying to capitalize on the other person. And if you are still using the same traditional approach, trying to navigate these new, because what you're seeing here is you're just seeing a market that is reflecting the state of the world. There's economic uncertainty that is being reflected in the markets. And you can also see that being reflected in bond prices. Bonds have essentially been consolidating since September. It's not really done anything. It's not gone up. It's not gone down. It's just been sideways. That's why you can see dollar has been in that sort of consolidation also since September. Remember the correlation between treasuries and dollar, right? The reason why between September going to current price action, you've seen a lot of disparity between supposedly correlated asset classes. I could give an example. We can use USDJPY. You can see USDJPY between September to current price action has been bullish, but that is not reflected on dollar, right? We can do the same thing for euro between September to current price action. Actually, we've been both bearish, and it's just been a consolidation again, right? So we can go and look at a different asset class, like maybe Aussie, for example. And between that time period, Aussie has also been bullish. Now, we have a situation in which Aussie is bullish and USDJPY is bullish, and USDCAD is massively bearish. Can you see the disparity I'm talking about? This is extreme. In hindsight, it's easy to say, okay, well, I could have found this opportunity, but you have to be realistic. If you're trading in this kind of market, imagine you're going long on Aussie and you go and take a look at USDJPY, and USDJPY is also bullish. Do you not think that would affect your confidence in your longs in Aussie? Yes, it would. One of the key elements of a high probability trade is market symmetry, meaning if I am going long in Aussie, I want to see dollar yen sell short, or even if it's not going to sell short, I want to see remaining in consolidation. I want to see euro go up. I want to see pound go up. I want to see USD go down. I don't want to go long on Aussie dollar and then go and take a look at USDJPY, and USDJPY is also bullish. That just makes me start to second guess if I am right or wrong. And this is what you typically get with decoupled markets. Now, let me explain the concept of a decoupled market. A decoupled market generally, right, again, because a lot of the assets in which we are leveraged in on, they have ties to dollar, right? Dollar is the reserve currency of the world, right? When we have macro conditions in which bonds are consolidating, that is a reflection of a lack of liquidity, right? Remember the correlation between dollar and bonds, right? T-bonds is the inversion of interest rates. Interest rate is the single biggest factor that affects currency prices. If we have a consolidating bond prices, it means interest rates are flat. If interest rate is flat, there's no incentive for liquidity to either pour into an asset or move out of an asset. So that lack of incentive for liquidity to either pour into an asset, which would cause bullishness, or flow away from an asset, which would cause weakness, leads to a condition in which there is no sponsorship in the market. If there is no sponsorship in the market, the algorithms will seek low level liquidity. That's where you get all the back and forth. That's where you get all the expansions outside your kill zones, because it is not a reflection of institutional sponsorship. Instead, it is other participants trying to cannibalize on lower level liquidity. That's why you're getting asymmetry in price action. Asymmetry is a reflection of a market that is decoupled. A decoupled market is a reflection of a market that has no liquidity inflows or outflows. And usually this can be due to the fact that there is maybe economic uncertainty. If there is fear in a specific asset class, we would see that being reflected with outflows, liquidity outflows, which would then lead to lower prices. That is all it is. That is all it is. So when we have a situation in which a lot of investors are in standby, and you can see, for example, Warren Buffett's company, Berkshire. I think right now this is they're sitting on the most amount of cash ever, right? So I could probably go pull up the article where, just give me 1 second, real quick. If I could find the article on this, I don't think there's a way. Is there a way I could search? Okay, I could probably search like this. Berkshire. I just wanted to find. Okay, yeah. So you can see this is November 1st, 2025, and you can see Berkshire Hathaway now has $382 billion in cash. Right, they're literally sitting in cash. Again, forget about the national debt. Right, we're not going to talk about all of this. My job is not to talk about national debt or whatever. But you can see his company is sitting in the most amount of cash. Now, of course, this is the greatest investor of all time, right? And they are sitting in the most amount of cash. We can typically assume this behavior can be mimicked or mirrored by other institutional firms, right? Where these other institutional firms, now obviously they're not disclosing, or we maybe are not privy to the information of what assets you're invested in and whatnot. But just the fact that one of the biggest investment company is sitting in the most amount of cash, meaning the cash is not leveraged in on asset classes, that should show the reflection of investor appetite in this current situation. And the reason, the obvious reason for this is just due to the fact that investors right now are risk averse. And risk aversion usually is a reflection of geopolitical event and economic uncertainty. That is what is going on. That's what you're dealing with. That's why Bitcoin is heavily manipulated. And gold is doing one thing. And currencies are doing another thing. And equities are doing its own thing. Because there is no general inflows of liquidity, right? There's no inflows of bulk liquidity into asset classes, right? So that's the kind of market we're trading in right now. Now, obviously that could change in the upcoming weeks, in the upcoming months. But my advice in terms of starting the new year and your approach to the new year is typically fund level liquidity will resume full on speculation. Typically they take the first few weeks of January off, right? But the main thing I wanted to draw your attention to, of course, is the fact that we have NFP week this week. Now, personally, I am not trading whatsoever until post NFP, so I don't care. Of course, I'll still cover price action and what I think, but I really did not care until after NFP release, right? And usually what that does is NFP release does a little bit, would set the intention for the next quarter, right? I'm not talking about the rest of the year, just the next quarter. Or I can trade an insight as to what the market wants to do. But I do have some few ideas as to what I think the market should do. Now, again, remember, I am not trading on dollar. Maybe until the upcoming week, that's a potential, but I think that is less likely again, right? Because for me, there has to be evidence of institutional sponsorship, meaning we need to see bonds start to trend. They have to get out of all of this consolidation and start to trend. So if they trend lower, which is what I expect right now, because I do think that we should see a bit of bullishness in DXY. Now let me explain my perspective real quick on dollar and what I think. Again, reminder, earlier and during the summer of the year, exposing yourself to the market is just calling to start off the year with a lack of discipline, right? Personally, what I think on DXY is that we will resume. This is what I think is pricing. I think the market would want to defend the low at FOMC, and the reason why I think so is because, again, you can say the last quarter was down here. The last quarterly shift way out was down here in terms of that movement higher in DXY, right? So if you notice, prior to the displacement higher, we made a run on a longer term low, right? So prior to the FOMC news on Wednesday, 17th of September, if you go back, you can see this was 77 days, 77 trading days back. That's a long-term low. So the market runs below a multi-month low at FOMC release. You know what is going down here. Institutions are pricing in, and then we see bullishness. Now, what I personally think with what is going on with the US invading Venezuela and all of the stuff going on, I do think for the next quarter, we get a bullish DXY. Now, obviously, this could change, and obviously, I do need to see proof of sustained upside. But I personally do think that we could start to see a market that trends higher on DXY with all of what is going on with the Trump cabinet and what they're trying to do with the petrodollar and all of that. But I do think eventually a lot of countries will start to move away from the dollar with all of the... I don't want to get into all of that, so I would just save it for a later rant, actually. But what you can see here with DXY is we sold off down into this volume balance, and this was a target I was calling for on DXY after we put below slowdown here. I mentioned that I do want to see the market, rebalance this gap. Now that we've done so, I'm looking at the nature in which we traded down into this gap. So you can see here, we traded down there below this near-term low. The market reaches a little bit, and then we go below that low one more time, right, into the gap. And then we're starting to see a bit of a recovery in DXY. I personally think, right, with the way we've ran below the slowdown here, filled in the gap, right? Down candle, another down candle, expansion, volume balance. Look at the way we gap through this volume balance. And then on Friday, we trade below this daily candlestick low like this and expand a bit higher. Which is why I'm more inclined to think that going into next week, right? If we defend this bullish order block, this candle, I personally think the market wanted to revisit this inefficiency. This is a given for me, right? So obviously if the market defends this bullish order block, then this is a given that it trades up into this. But I don't think we trade up into this and sell off. I think we trade up into this and trade through. And this becomes a breaker block, right? So I personally think if we trade above this eye here, this is what is being priced in. The bias liquidity. We have clean eyes up here. And I personally think not only that, but we're going to start to see the market run up to the side here. Okay. And what that would lead to is also equities rallying and Trump gloating about the fact that the stock market is moving higher, because that's the only thing this guy cares about, right? So we see higher prices in the DXY, right? We see equities rally. If we go and take a look at gold, you can see gold has gone above all-time highs like this. Now, Here's what I think about gold. And that takes me back to the last time I leverage traded on Bitcoin, right? The last time I leveraged traded on Bitcoin, I think I took about three back-to-back losses on my investment. Typically, when I go and leverage trade, especially in Bitcoin, I like to use a 10% risk, 5 to 10% risk in Bitcoin. Right, so it means more. If I make money, I make a lot more. If I lose money, then I will lose around 10%. Right, so the last time I traded on Bitcoin, so if we're going to take a look at Bitcoin, the last time I leveraged long on Bitcoin was what we're still 100K in Bitcoin. I think it was down here. Yeah, down here was when I my final attempt at a long, and then after that I mentioned I would not be looking to trade Bitcoin in terms of leverage for a while until I could get a confirmation that Bitcoin wants to be bullish. Now I personally think Bitcoin would be bullish from here. Obviously, we need evidence, and what I've been doing is just accumulating spots. So obviously, more spot being accumulated. Actually, not just more spot, a lot of spot being accumulated down here on Bitcoin because I think we start to see a bit of a relief in Bitcoin. But in terms of leverage trading on Bitcoin, especially, I think we're starting to see a flip, especially with the way gold, the level we're at on gold. Now, for me, I want to see gold trade through this fair value gap. I'm going to see gold sell off and trade through this fair value gap. If we get a sell off, or if we get a trade through lower this bull fair value gap, then I think Bitcoin is priced in for 146K, right? Because I would want to see gold at least go and clear out fund level liquidity down here and down here and down here. And if we're more than likely to get that lower price in Bitcoin on gold, not Bitcoin, then that essentially causes gold and Bitcoin to reattack the support level down here, right? I think we get more lower prices in gold as gold starts to run lower and Bitcoin starts to go up. Right. So for now, again, like I maintained before, as per the last time I was leveraged on Bitcoin, I will step away from trying to leverage trade on Bitcoin and focus on just accumulating spot. And I do think potentially on Bitcoin, we could see the market rally from here. And I do think that it will catch a lot of people off guard because a lot of people are losing faith in the crypto market because essentially we are at a point of max pain in the crypto market, right? And like I mentioned before, I said if we lost that 100K level, then I would expect that price we essentially visit this weekly order block down here, which we've traded down into, and that would be a next level where I would expect price to actually rally from there. Now, if you look closely on Bitcoin, you can see we've not actually closed below this weekly buy some balance source and efficiency. If you look at the bodies of candle, yes, we spiked there into the main threshold of this bullish order block. Yes, we've seen a lot of back and forth, but personally, and I said personally, excuse me, but we've not seen a closure through that inefficiency, right? That tells me that we're still very much bullish in Bitcoin. And I personally think we do rally from here in Bitcoin. That sounds insane. Obviously, I'm not going in and leverage trading Bitcoin. Spot trading is sufficient for now. A lot of spot trading actually is sufficient for now in Bitcoin. And I personally do think that you might potentially regret this big time when Bitcoin does start to rally. You might. Not might, but you will regret this big time if you're not accumulating spot. This is the best time to accumulate a lot of spot on Bitcoin. Obviously not leverage trading, but for spot, you should be doing so. the risk is minimal, right? At this point here, a lot of people have given up on Bitcoin. Altcoins, same thing, right? So, in terms of an actual investment advice that you can not bank on, but uh, uh, um, you can take action on. Right now, I think the go-to is Bitcoin. That's what I think. I think for currencies, we need more time to allow sentiments to build, allow institutions to reveal their positions, and also just not necessarily their position, but just to reveal their sentiments, right? Which I will cover on a daily basis and also on a weekly basis. So obviously, as from today, we start to get a lot more daily videos because I'm back into grinding for the year. Obviously, not trading in currencies. I'm focused right now just on Bitcoin in terms of spot bags. And once we get that confirmation, and for me, the confirmation will be a closure above this down candle. If we get a weekly closure above this down candle, and we see gold trade below that fair value gap I talked about on the daily time frame profile, then I will resume leverage trading on Bitcoin, right? Along with my spot bags. Now, what I do is I keep spot and leverage trading different, right? For my spot bags, I view that as investment, right? For leverage trading on Bitcoin, I view that as profits that I can take and spend immediately on, right? So it's the same as trading currencies, for example, or gold, for example, right? It's just I'm using a lot more leverage, right? Because I'm looking at more longer term targets versus when I trade currencies where I'm most likely short term trading, right? Or day trading, right? So currencies, I typically do a 1% risk per trade. And then for Bitcoin, generally, if it's a swing trade, which mostly is, I never short term trade or date never, right? So it always is a swing trade, always. So because it is always a swing trade on Bitcoin, I usually will use a 10% risk, right? So if I'm doing a 5R, that's a 50% gain, right? If I'm doing a 6R, that's a 60% gain. If I take a loss on trade, that's a minus 10% loss. But I have a separate account designed specifically for that, right? So I'm not mixing my leverage trading in Bitcoin with what I am doing on currencies, and the same thing goes for equities, right? So different accounts, different trading accounts for different asset classes, right? So if you want to trade Bitcoin, obviously you're not doing so on a funded account. You need a live account. So you can actually fund with like a $500 live account, right? For leverages on Bitcoin. And once I talk about where I'm looking to execute, once we get the confirmations we're looking for, then obviously you can risk 10%, 20% on your account because you're looking at that as investment. Meanwhile, this is the best time to accumulate spot on Bitcoin because I do think we will start to see a pop on Bitcoin that will catch a lot of people by surprise. And also on altcoins, a lot of people who have given up on crypto. And then once it starts to rally, you will start to see everyone come back and start to talk about Bitcoin and start to talk da. So, well, it's been a really long video for now. I hope you enjoyed this really long talk, and I will see you in the next one. So I do plan to drop another video today on YouTube, and then going forward, I will do a lot more private videos. For now, I will talk about the situation of the Discord. Later on today, I will address that topic because I'm looking to actually downsize my Discord significantly. I don't like the fact that there's a lot of people on my Discord and I have to manage so many people. So I'm actually looking to make it just an exclusive group of a few people on there. So I'll talk about the rules and all of those things because going into this new week, I'm moving away from my existing Discord. I don't like all of the people, not all of the people, sorry, that came off wrong. I don't like the number of people on there. It's just way too much people for me to handle. And I want to focus a lot more on my own personal trading for this year, personally. So obviously, I love what I do. I love to work on videos like this. And none of my videos have been monetized ever in my 5 years of dropping videos. So just so you guys are aware, I've been doing this for free for the last 5 years. Now I actually do want to build my YouTube channel this year. So in the future, potentially, you might start to see ads. If you do so, just understand that that's just a way. If I'm going to start to give a lot more, drop a lot more content, do a lot more presentations, and you know, mark up the charts, stock or price actions, all of that, then there has to be compensation for my time, right? So I will obviously look to monetize later in the upcoming weeks, but for now, just understand all of the things I've been doing has been for free the last few years. Right? I don't really promote my Discord as much, or I don't monetize my YouTube, or none of that. I never really thought about any of those things, but now I'm actually looking to just focus my eggs in a few baskets and not be distracted by so many people just trying to come into my training group because maybe they see the win streaks or the performance. Obviously the losses did drive a lot of people away, which is a good thing, and I'm not complaining whatsoever. So yeah, but I will address all of that later today, right? So there will be a separate video specifically for existing Discord members. In the meantime, you guys all enjoy, and I will see you in a few hours, and in the meantime, trade safe. Peace.